value to almost anyone, and that made it a medium of exchange. And if it maintained its value, it was money. And today we don't. The actual pieces of paper and pictures don't really have any value to anyone. It's the meaning of them that has value. But yes, fiat to fail, fiat to fail. Ever since John Law, and they tried it even earlier in China. But so this goes back several hundred years. But when I was writing my book in 2005, I had a book called Manias, Panics, and Crashes, and then several other books like Milton Friedman's Monetary History of the United States. And I did a bunch of research, probably maybe 100 different websites also. And I put every mania, panic, crash, every monetary event that I could find in a spreadsheet, looking for cycles. I was a big believer in cycles, periodicity, and so that's what I was looking for. And when I did this, one big thing stuck out at me. Back then in 2005 and 6, you could read about the classical gold standard. You could read about the gold exchange standard between the wars. You could read about the Bretton Woods system from 44 to 71. And you could read about the current floating exchange rate global dollar standard of today. But nobody had connected the dots yet. There wasn't any place where you could go and just read all of those and read that there was a meeting of the finance ministers, treasurers, and stuff of the world's major economic powers in 1922, the Genoa Conference, to hash out a new world monetary system. And then 1944 in Bretton Woods, New Hampshire, to hash out a new world monetary system. And then was it the Smithsonian Agreement? What was the one in
Washington Accord, I believe.
Washington Accord, yes. So everyone, and that one, they all agreed on something, but nothing ever took effect. The old system just followed. The Bretton Woods system, was stopped. Gold wasn't being redeemed in the United States, the hub of the Bretton Woods system, and so we just sort of fell back on this default of letting the markets sort of take care of a floating exchange rate that doesn't have any gold backing it. But when I looked at it back then, it was between 30 and 40 years, because it took 10 years for most of the countries to jump on board the classical gold standard. 30 years, or 28 years, 30 years, and then we were at almost 40 years. And now we're coming up on 50 years of the worst designed system of all. And so, I said back in 2011 that, mark my words, there will be an emergency meeting of the G20 finance ministers or something like that to hash out a new world monetary system. The previous transitions were from full gold backing to 40% gold backing, depending on which country. US was 40%, to an unspecified amount of gold backing, with the US being the hub of all of the countries. Before that, it was the US and Great Britain, to no gold backing. So we went from a component in our monetary system of something that never fails to the whole world being on something that always fails. And to me, that has created the biggest financial opportunity in history. Although I do have to say that it's bringing on some pretty scary times when it comes to the potential of the world monetary system freezing up and things like that. What's your take on all of this again?
Well, that was a very good summary. I'll just repeat back really to reemphasize. I mean, going to my early work, the key idea was that all fiat fails, and this is the first time in recorded history where it's a global phenomena. So if you go back, I think Marty Armstrong recently just did an update on currency crises and governments, and he made a lot of really salient points. But the idea that this is the first time that it's going to be the massive fail of this size, Marty pointed out that the Weimar Republic, a lot of people went and got currencies of other countries nearby because they could see what was happening. But you don't really have that opportunity now in the currencies, but you do with the precious metals. So I just like to get a further emphasis on that, or your thoughts on that.
Well, I pointed that out in my book back in 2007. I wrote that, with all of the other failures, there's been a hard currency in a country right next door that you could run to. And this time, there's going to be one currency or whatever that people run to temporarily, and it outperforms a little bit. But all of the currencies are falling compared to gold. They just fall at different rates. And that, what I said in my book was that will make this the greatest wealth transfer in history, that nothing like this has ever happened before. We've taken all of the bad things that have happened in the past with currencies and just magnified it and multiplied it by so many times by doing this experiment that is proven not to work time after time, and we're doing it globally. It was crazy, and it still is crazy, and we're getting near the end of it. We see that the world is about to transition to a new monetary system. So my prediction of in this decade, which ends December 31st, that might be wrong, but probably not by more than a year or two.
All right. I think we hit monetary past in a cursory manner, but we don't have a lot of time here. And I think it's more important for our viewers to look at money present and money future. Is there anything you'd like to talk about in the past before we move on to our present monetary system?
No, just that, each time it did come back to precious metals, and there have already been rumblings by central bank officials saying that the next monetary system will probably be connected with precious metals. And most of the world's central banks still carry them on their balance sheets.
All right, so moving into the present monetary system, since we're about the same age, I don't want to upset you, Mike, but we have lived through a point in history where actually silver coinage still circulated in the United States when I was a child, 10, 11 years old. And then under the Johnson administration, they started producing what I call the Johnson slugs. And then August 15th, 1971, Richard M. Nixon took us off the gold standard temporarily. Remember the word temporarily, because of the speculators. So we've been in this fiat fiasco ever since. Now, when that occurred, there were very few people, any gold bugs that, raised ire and got up and said something. There were some. James Blanchard went to Washington, D.C. and got out of his car and wheeled up to a platform and basically said, "You don't know what you're doing. This is going to be the demise of," and I won't, this is my summary, my paraphrase. I don't remember the exact speech, but basically, "You don't know what you're doing. This is going to have dire consequences." I'll leave it formatted in that manner. But most people didn't pay any attention. I know as a kid, most people could care less if the coinage changed. And of course, under Gresham's law, the silver quickly went into hiding. So that's the basis of the present system. And as we've already discussed, it's on a destiny to doom, a destiny to fail. So we have gotten to a point where it continues to accelerate, meaning more and more printing is going on. We can't print our way out of this. We can't borrow our way out of this. And yet that seems to be the modus operandi for the central banks. So let me turn it over to you. I'm sure you've got a great perspective on the present monetary system.
Oh, first of all, I want to let everybody know that you're one of the people that actually got me started in this. I went up to the Cambridge House precious metals show back in the hard assets show. Cambridge House, can't remember the name right now, sorry. But I think that was 2003. And you were speaking there, and so was James Turk. And when I was just getting into monetary history then, and when I saw the charts that you guys presented and heard the stories, that's when I just fell in love with this subject and decided to dive into it. So I want to thank you for that and just let everybody know that you're one of the people that helped me get started. But the current monetary system, this is a mess. you can't, I just did a presentation where I gave an example of a little steam shovel going along, and you have a certain level of prosperity. And then you borrow a little bit out of the future and stack it up in front of you. You're able to climb upon a higher level, but now you've got a pit in front of you. So you always have to go out into the future. And if you look at the pit, you've got these filled in areas, and then you've got a cliff, and you've got the 30-year bond, a little pit out here, and then the 30 plus a 20 and 30 plus 20 and 10. And then you get all this private debt like automotive and so on, and credit cards. So you've got this, we keep on going to this higher and higher cliff, and we keep on digging the pit in front of us deeper. And you can't stop time's forward march. You always have to go forward. And one day we're just not going to be able to dig up enough dirt to keep us from falling in the pit, because, as long as nothing happens, we can count on this working out. It'll always work out as long as nothing happens. The problem with nothing, and I'm sort of paraphrasing Richard Russell or Richard Doughty here, the problem with nothing is that you can't count on it. Something always happens. And it does. And right now, we've just seen something happen with the world economy. You can't have ever increasing levels of debt and shrinking GDP and expect to be able to keep on borrowing, especially at negative interest rates. It's a crazy thing. Negative interest rates just show, is this possible, David? Negative interest rates, is it possible in any world except a Keynesian world?
Let me add on to that. And this is a little bit of a thought that just came, and that's, why do you think that, it's so obvious to those that look into this subject, and it does take some study, it does take some effort, but the vast majority are just blind to the economic system and the Keynesian model, and that it's always failed. Why do you think that's the case in the present monetary system?
Are you talking about the public being blind?
The public.
Okay, because you can even go to into the banking sector, and they don't understand it. And even on Wall Street, they don't know how the whole system works and what's behind the curtain. And I don't know how we got on this system where the only thing that backs the currency is the ability to tax us in the future. That's what backs the currency, is enslaving us for the next 30 years. And every year we add another year to that. So there's always 30 years of enslavement where you have to work to pay off what you spent. We're just paying off what we spent 30 years ago. Was that George Bush Sr. or was that Clinton? I don't know. But it's an insane system, and it's doomed to failure. It's been proven. There's been thousands upon thousands of fiat currencies when you look through history, and up until 1971, none of them survived. And when you look at all the currencies that exist today, none of them are the same currency that existed before 71. Before 71, the US dollar, like the Bretton Woods system, it was backed by gold at $35 an ounce to foreign central banks. Completely different US dollar than exists today. But I'm pretty sure, the last transitions from the classical gold standard, gold exchange standard, Bretton Woods, US global dollar standard, those transitions were baby steps off of gold. And the only people that felt it were the world's central banks and the big international banks and international corporations, because exchange rates changed and stuff. This time we're going off of this confusing floating exchange rate regime, and we're probably going back to something that will give faith in the currency, and that's gold. That's going to be one giant leap. I believe everybody on the planet will feel it, and people just have to make up their mind if they're going to have wealth transferred away from them or toward them, because it's their choice.
I'd like to stay on this subject just a little longer. I'll play devil's advocate, because this is some of the feedback I've gotten from the public, from our peers, especially from some of the people that, we rub elbows with at on the speaking circuit. And it goes like this: David, you know, we've been hearing this thing for such a long time. Howard Ruff, Jim Dines, James Sibbett, all these Harry Brown. We've heard this, you know, failure, that this thing's going to collapse. And look, you know, things have gone just fine. I mean, you guys are just a bunch of doomsayers. I mean, I've never felt better. I've never done better. I mean, why don't you guys get off this kick that, you know, this is going to happen to us? And of course, you and I both know we're a lot closer, but you know, these people, and they're right. I mean, you know, Jerome Smith, one of the people I studied the hardest and subscribed to everything that he wrote in his private newsletter. You know, it looked to me like in the 80s, it was imminent. I remember the book, still my bookshelf, Bankruptcy 1999. You know, we're looking at a couple decades beyond that. That was a Grace Commission doing a study for the Reagan administration about the fact we were bankrupt back then, and we were. So what would you comment on this idea that you guys are just, you know, overblowing the subject? Things are, you know, it's not going to happen, or it's not going to happen for a really long time, and all this stuff. Now, that's not so much the case right now, as, you know, we're doing this real time in late, you know, the fourth quarter of 2020. And I think a lot of people have their eyes open. But I just want to go back. We're talking about the present monetary system and the feedback in earlier days, and not that long ago, that everything's okay. What are you worried about?
Well, there's two things I'd like to say about that. And the first is to paraphrase Doug Casey in saying that, you know, in crises such as this, things unfold very, very slowly until the day they don't. And then they happen really fast. The other is that those people that were saying that all of us doomsayers, the people that were saying there was a crisis coming, they were right until the year 1990, 2001. If they were still right, gold would be $250 an ounce and silver would be below $4. If they were still right, but they're not. This is happening very slowly so far. It's taking 20 years for the system to fail. Gold is the canary in the coal mine, as Alan Greenspan used to say. You know, it's a barometer of how well fiat currencies are doing. And we've hit $2,000 gold. Gold used to be $200. I mean, I'm sorry. It used to be $20, $20.67 an ounce. And now we were at 2,000 something. So that is the dollar failing. What is that? 99% loss in purchasing power against the dollar against gold since 1934. But still, this is a slow process. They did sort of manage fiat currencies well. But when we got to the end of the George Bush administration and there was the global financial crisis and the response was more than $1 trillion worth of deficit spending, we started abusing the system so much. And then we started abusing the global dollar standard, and we started weaponizing the dollar and freezing countries out, freezing all of their banks and their financial system out of the global financial system because they couldn't use the SWIFT network. When we weaponized the dollar, we shortened that fiat currency lifespan. And the deficit spending that we've done shortens the faith in the US dollar, that lifespan. And I'm sure you agree, right?
Oh, excellent answer. Let's move on to the future of money. There's, a debate going on about whether or not the next monetary system will have gold incorporated in it or not. And then being, free market aficionado, I'm well versed in wanting competing currencies. The cryptos are there. There are, there's some local currencies. There's a lot of ingenuity going on in how to make a medium of exchange between people. So this is a really broad topic and no one knows the answer. So let me just turn it over to you. Tell me what your thoughts are on the future of money.
I'm an advocate of cryptos as well, and precious metals. There aren't any cryptos on central banks' balance sheets. And the central banks are definitely going to try to continue controlling the game. They do not want you using alternate currencies. the if they want to keep you using their currencies, what the IRS has already done is made it more difficult, because if you do settle a transaction with a crypto right now, you're supposed to be claiming that the capital gain is whatever the dollar value is of the crypto, the time that you make that payment, convert it into dollars, there's either a capital gain or loss there. So you're supposed to report all of it. It isn't just like pulling cash out of your pocket and making a transaction anymore. They're going to enforce that more and more. They can't stop something like Bitcoin, but they can limit the access points for conversion into dollars. So you'd have to have transactions that are purely in Bitcoin or some other crypto. And all of the world's, not all of the world's central banks, but the world's major central banks have already announced that they're working on blockchain technology, direct payment systems. And so, one of the reasons I think for the delay in all of the stimulus that the government, politicians want to give away what they call free money. They don't understand the difference between currency and money. It's not money. It's currency. Money has to be a store of value. Currency is designed to lose value. All the national fiat currencies are not money. But anyway, one of the reasons I believe for the delay is they're blockchain-based crypto. But there's actually a bill in the Senate for the Federal Reserve to direct the Federal Reserve to create crypto wallets, and then stimulus would be deposited into these wallets. And who's not going to download a digital wallet for their phone when there's $10,000 sitting there waiting for you? Everybody's going to do it. They're going to get us hooked on it. And they're going to try to ban cash, except there's something bigger coming. The markets, I believe, will overwhelm this. I've done most of the talking. You should wrap it up by giving us your big picture on the future of this system. But the thing is, the central banks, most of them, do continue to have gold as a tier 1 asset on their balance sheets. It's tremendously undervalued. The Federal Reserve keeps it on the books at $44.2222. But if you went and made cash currency, the base currency that's in circulation out among us, that requires about $8,000 an ounce. And if you do all bank reserves, then you're talking about $20,000 an ounce roughly right now. And they're not going to stop printing. And so to give it ultimate faith, and they don't want to do this. They're only going to do it if they're forced to do it, to give the currency confidence. Otherwise, they may try some sort of fractional reserve scheme, but what they want to do is force us to remain on this debt-based monetary system where you have no other alternative. That's why I like physical gold and silver. And right now, I think gold and silver are going to be doing a short-term pullback here, and I intend on getting some of the stocks because the leverage that you get from those. A bottom in the stock, the GDX or the HUI, which is index for gold and silver stocks, a bottom in that compared to the price of gold is like a signal it's time to buy stocks because they're going to outperform gold. But I believe everybody should have a foundation of real precious metals in their portfolio. So I'm sorry I rambled.
No,
Go ahead.
I'll take over. Yeah, just to reiterate some of the most important points I heard, and that is I've always maintained that you should have physical metal first before you do any type of investing beyond that. Also, the central banks are not going to give up power easily. I think if you went into Google and looked at trends, you would see CBDC, central bank digital currencies. This is trending massively right now. We have studied it in the Morgan Report for a few years. Going back a couple of months, maybe 3 months, I wrote about Mark Carney when he was with the Bank of England. basically spelling out at Davos, the United Nations, and one other major place what they want, the Bank of England wants, which is a non-backed, digital-only, cashless system that's backed by nothing where they're in total control. So I think that's pretty clear what they're shooting for. Now, whether or not that's obtained or not remains to be determined. And your point about Bitcoin is very similar to what I wrote a few months ago, which was, I don't think the banks are going to care that much about Bitcoin and some of the cryptos. But what they will do, in my view, doesn't mean it's going to happen, but I usually have fairly good insights into this stuff, is they'll say, look, you can do all the Bitcoin you want, but if you want to get a mortgage, it's got to be on the Fed coin. Now, Fed coin, I called it FedCon, just so you know, Mike. But this digital currency issued by central banks, so pick your central bank of your choice. I'm just using Fed coin as a metaphor for a central bank digital currency. So you could substitute any of them for that phrase. So they're going to say, if you want a mortgage, you've got to use the Fed coin. If you want to have utility payments, you've got to use Fed coin. If you want to have an auto loan, it's got to be Fed coin. But no, you can use all the Bitcoin you want. You just can't pay a mortgage. You can't get a utility. You can't get your cell phone bill. You can't buy groceries. But hey, anything else you want to do, have at it. And I think that's the way they're going to go. So they're just going to kind of ignore the competing currencies for, let's say, the basic material needs of humanity, and keep control that way and just kind of push the competing currencies off to the side. What do you think about that?
I think that that's exactly what they'll do with the extra work. I mean, if you're talking about businesses and local transactions being able to accept Bitcoin or any other digital currency, and FedCoin, FedCon, and then all debt and utilities and major transactions having to be done in FedCoin, including paying your taxes. But that one of the layers that they add onto that to keep you from using the alternate currencies, the competing currencies, would be all the tax reporting that might be involved in, you have to keep track of every transaction. Tax returns are getting so complex. Do you understand anything on your tax return anymore? I sure don't. One year I had a tax return that was it was almost 3/4 of an inch thick.
Yeah, I hate to comment on it. So I'll quote Steve Forbes from, I don't know, a decade or more ago. I forget the exact numbers, but the idea is clear. I think there's something like 32 feet of tax codes. I don't know what's in it. You don't know what's in it. And they don't know what's in it. It's time to scrap the whole thing and start over. That's almost a direct quote. And he was running for president at the time, not on the ticket, but he was in the preliminary warm-up. So let's look a little further on the topic. And that is, do you think that the banks could be forced to put gold into the equation to gain trust? In other words, if Carney has his dream, non-backed, we just have control. Oh, and modern money theory, I forgot to throw that out there, Mike. Doesn't matter how much money you print, it's going to work out just fine. Do you think they could be forced to kind of hitch on to gold in some way, shape, or form?
I don't think these guys understand basic economics. They can see the trees, but they cannot see the forest. They just don't understand the foundation of what economics is. They've got their equations and theories, but I can't see anything like modern monetary theory actually working. Yes, the whole thing about central banks keeping gold on their balance sheets all these years when it's supposed to be a barbarous relic. And then, of course, the Western powers like the Bank of England, the Federal Reserve, even though the Federal Reserve, and this was the Federal Reserve's gold is basically all of the gold that the US has. They've got gold certificates claiming on it, but this was the gold that people like, I used to, back in the 90s, I thought it was at Fort Knox. That's not the U.S. gold. It's the Federal Reserve has a claim on it. It is the U.S.'s gold, but it's been hypothecated. It's got a claim against it by the Federal Reserve with these $100,000 gold notes, and it's almost all of the gold. If there is a crisis, there's a reason that it's on the balance sheet, because they can basically write off all of the other, they can forgive debt completely. If they made $20,000, if they just made gold redeemable at the dollar redeemable at $20,000 per ounce, then they don't, everything else on their balance sheet can fail. And they are still completely solvent. And all it takes is being ready standing ready to buy or sell gold at a fixed price in any quantity. And when you're raising the price to that, what happens? Gold, people don't understand that gold standards are self-funding. You just offer a price that's above current market, and all of the gold miners want to sell to you. And so at $20,000 an ounce, the Federal Reserve or the US government would have a huge boom. And that's what happened after the price of gold went from $20.67 to $35 an ounce. There was a huge flood of gold into the US that ran all the way up to World War II. Now, part of it was Europe, the combatants in Europe, paying us with gold when they would buy the supplies that they weren't making current. But the other part of it was that gold miners became incredibly profitable, like Homestake Mining, for instance. And their major customer was the US government. And so, I do think that there is a fairly good probability that gold will have something to do with the equation. And that would mean the central banks changing the price they keep gold on their books and starting to do international settlement in gold. And if they're doing international, it's interesting that Russia and China, Russia doesn't need to accumulate gold anymore. They've got enough gold to back their currency. They can back the currency in circulation right now. They don't have to raise the price to $8,000 an ounce. So they're comfortable. I think the Western central banks are still nervous. And the reason they want it to be mandatory to use their digital currency is because they don't want power to go back from west to east. It's part of the east-west cycle. And if Russia and China already have, like China, we don't know how much gold it's got actually. They give a report. They probably have a whole lot more than they do. But if they've got more gold per capita in their country, then they are richer and more powerful and will control the future monetary system and be the economic powerhouses in the future. And these things are not something that central banks or governments want to give up. They're going to fight tooth and nail to be, basically right now, the Federal Reserve and the US government are basically like the house in Las Vegas, and everybody is playing their game, and they make a little cut off of everything. They don't want to lose that privilege. So gold does play a key factor, but gold puts a constraint that they will not want to see on them. So.
Great. I think we've done a pretty good summary. We spoke off air yesterday. I just got a question this morning that I get again and again and again, which is it too late? Silver's made this move recently this year from the $12 paper price all the way up to 30 intraday or momentarily. And now, of course, we're correcting. And this person wrote, I bought silver at, I forget the exact price, 28. I've continued to accumulate. Am I doing the right thing, so to speak? So we spoke off air about, you did an excellent presentation recently on what gold would look like if it simply matched what we saw in the 1970s bull market. Do you have the ability to share your screen and bring that to everyone?
Yeah, that's over on a different desktop. It'll take me just a second to get there.
I'll just talk a little bit while Mike's looking for it. The idea is that I've said many times that, and this actually came from Jeff Christian years ago at one of the silver summits, and he said 90% of the move comes the last 10% of the time. and I had ears to hear, so to speak. And I thought about it, and then I actually did the arithmetic in the 1970s market. And really, silver went from $6 to $50 in about 1 year's time, over an 800% gain. And depending on how you measure it, it was in less than 10% of the time. So it's not a strict math formula. It's not a guarantee. It's nothing more than the idea that all markets have exhibited, which means if you're an Elliott wave person or not, there's usually three major legs up. The last one, the third leg up, is the one that has the most momentum, captures the public's attention, goes into a mania phase, and you see the greatest gains in price in the shortest amount of time. So it doesn't mean 90% and 10%. That's just the idea that the biggest gains, and this is where we're just entering as far as I'm concerned. We entered it very recently. I would say we probably entered that phase this year. And those phases, again, if it's 10% of the time and we have a 20-year gold market, you take 10% of 20, that'd be 2 years. But that's just the idea. Does that mean it's exactly 2 years? Not at all. Could be 3, it could be more, it could be less. I don't know. What I do know is Mike did an excellent presentation. Mike, let me turn it back over to you if you have it.
Well, I can't, it's not giving me the choice to put the file up. Sorry, Zoom.
That's okay. Just announce the name of that presentation. People can dig it out on their own. Maybe we could put it in the notes or something.
It's on my channel, and I believe it's titled $11,250 gold, but when? And what it shows is that gold should rise if it continues. What I did was pretty simple. There was a rise starting back in 1999 and then almost a double bottom in 2001. And it went up, and there's something called an A wave in Elliott wave analysis. And then it did a pullback in the called a B wave. Well, it did the same thing back in the 70s. 71 to the end of 74 was the A wave, and then the B wave was first day of 75 through, I believe, August of September of 76. And then there's a C wave, and the C wave is the biggest move and the most powerful. And the end of the C wave comes very quick. The gains are huge. And so what I did was I had my spreadsheet master, Alan Hibbard, make a spreadsheet, and it came back with this thing that had buttons on it, and I could just compress the time scale and the magnitude of the chart to line up the A wave peaks perfectly. And what you see is that from 1971 to 74 and from 1999 until 2011, that A wave match up almost perfectly. And then the B wave and the beginning of the C wave, the correlation is so spooky. This is just it's history repeating. I think it was Eugene O'Neill that said, there is no present or future, only the past happening over and over again now. And that is exactly what's happening. And what it shows is that in November of 2023, if everything happened just like it did in the 70s and the market just progressed and it was just history repeating, nothing special, we would have $11,250 gold in November. And that is a 6-fold increase from where we are today. That's if the currency system isn't failing. That's if you don't have a pandemic. That's if GDP isn't shrinking by these horrific amounts. That's if you don't have these super high levels of unemployment. That's if there is no banking crisis because nobody is paying their mortgages or their rents, which means a banking crisis is inevitable. There's something coming out there that's huge. You just can't have a debt-based society. We have no savings, none. And we keep on leveraging ourselves out further and further times the size of the economy, GDP, or further and further times the size of tax revenues. That can't go on forever. It's impossible. So what's your take on that?
Well, I think that was one of the best presentations personally that you've made. And, you know, the secret Well, I can't remember the name of your series, Hidden Secrets of Money. I mean, what, 50 million views? I mean, you have educated so many people, and I want to compliment you. I mean, yeah, we were introduced pretty early. I remember the early days of the Silver Summit. I don't want to digress too far, but you've done so much for so many for so long, and I want to compliment you there. But no, I think that is probably the most succinct presentation I've seen. And I just want to reiterate, this is happened in the 70s when the system held together. Yeah, there was it was U.S. only. It was much worry about inflation in those days. Everyone had a hawk eye on the M1 money supply. The bond vigilantes did their job. Bond prices were basically the price of money was very carefully monitored by the free market, at least in my view. And then what happened was, as it got to a runaway point, Volcker came in and put up these interest rates to quell inflation, squeeze it totally out of the system, and he wrung it out. And at that time, if you look at one of my earliest articles, Engineering the Price of Gold, you'll find that we could have gone on a completely gold-backed standard on the M1 money supply, the base money, at a ratio of $400 the ounce, and yet we had peaked over $800 the ounce. I mean, we had like a 2-to-1 cover on the base money supply. Of course, Volcker was, sort of anti-gold and anti-silver. Don't have time to explain. And so we stayed on the fiat system, but, it worked. What you're saying now, I think, needs to be reiterated slightly on my part, which means we didn't have a global crisis. We didn't have the shortage of the food situation with all the breakdowns in the supply chains. We didn't have this cyber war potential. We didn't have the weather changes that are causing crop dislocations. We didn't have the anxiety in the population at large, which isn't just U.S. You got the yellow vests, you've got the Hong Kongs, you've got the Taiwans, you've got the Middle East, you've got all kinds of problems. So if you think that we're just going to 11,000, which is just a number, it's the idea that gold and silver have not caught up to not only the amount of printing that's taking place, but the amount of chaos, crisis, and currency failures that this time is global. So hopefully I surmised that fairly well, Mike. Would you like to add on any more?
Just a couple of things here. That the time scale on that chart that I was talking about, where we're having this exact echo of the past, they aren't exact. It's 2.42 times longer in duration, but it's 1.8 times greater in magnitude this time.
There was sorry to interrupt. There was a projection. What was it? November 2023? Was that the number?
Yeah, November. So, late 2023. It doesn't follow exact, but where we are right now is almost exact. It tracks the 70s bull market almost exact. The correlation would be far greater than 0.9. And a correlation of 1 for the audience is that they are exactly the same. If it's got a correlation of 1, you're measuring a can of Campbell's soup against a can of Campbell's soup. It's the same exact thing. 0.9 is huge. That would be tomato soup against chicken noodle soup. Would be a greater than 0.9. So it is spooky when you see this, and it's basically human action. It's our herding instincts. We're all but the anxiety that's going to happen at the final stages of this blow off, I think that there's a great possibility that 11,200 is an extremely low side estimate.
I agree.
All right. Well, thank you, gentlemen. We really appreciate your time today. We have run out of time, but that was a fantastic presentation. We do appreciate you.
Thank you.
Thank you.